Barua, Head of Credit Products, Wealth Markets, Products and Sales and Wealth Management, Standard Chartered. It's a pleasure to have you visit here in Nairobi from Singapore.
Thank you, Ali Khan.
Pleasure. Can I just first get your thoughts on what is front and center for so many people, the US economy? Are you in the camp that you're expecting 3 more rate hikes this year? Are you concerned at all about the political risk in the US? How do you characterize what's happening there and what's your forecast?
Very good question. And absolutely, you're right. This has been front and center for a lot of the investment community. You've actually asked a number of questions. Let me break that down into smaller bits. So first thing about rate hikes. So we've seen 1 rate hike just recently. We think there is every likelihood that there will be 2 more rate hikes.
This year?
Yes, this year. But the bigger question is what those rate hikes are likely to do to the bond market. And our take on that is that the impact of the rate hikes is likely to be quite benign because a lot of what the central bank or the Fed has done is really managing expectations, if you will, for the market. So they've telegraphed their intentions pretty well. They've given the markets time to digest what they are likely to do quite well. Subsequent to the actual rate hike, the messaging has been very clear. So the markets seem to be a lot more sanguine about these rate hikes than was at one time feared, if you will. So the impact on the bond markets is not likely to be devastating by any measure. So we think rate hikes, as and when they come, unless there is an unexpected change in the dialogue, in the tone, in the communiques, we do not think it'll have a major negative impact on the bond markets. That's the first thing. Secondly, about Donald Trump and the political risk his presidency brings into the market. Yes, there is no question about the fact that there is a certain degree of political risk that has come into the markets, much more so than, let's say, in previous institutions. The United States, as you would well know, is a country of institutions. Most things they do, most things they decide on, most things they take action on is quite deliberated. Executive orders per se from the presidential office may not be the sole determinant of an action. So it is likely, though, that with his tendency to tweet, his tendency to speak off the cuff, there could be short bouts of volatility in the market, but ultimately I think the markets are quite efficient. They will digest that information and react accordingly, which is what we've seen thus far. So we saw a sharp sell down immediately after he took office, but subsequent to that, once the market had time to reconsider what had happened in the markets, unexpected as it was, I think it adjusted really well. And I don't think we've seen any strange reactions that no one could understand in the market since then. So political risk exists, but it's not something that keeps me up at night.
Can I just touch on a couple of other big areas?
Well,
Europe.
Yes.
How do you look at Europe now? I mean,
Europe's in a mode of recovery, and that's a very general statement. We had a very abnormal situation of widespread negative rates. That is, while there were technical factors behind it, it is not something that is completely sustainable as a phenomenon. It has happened in the past, soon after the financial crisis of 2008. We did see negative rates in various markets, but we've come off of that. I think it's the economies, the larger economies, which is where most of the growth comes from, are really showing signs of stabilizing. I don't think there is any real risk, including the Brexit event, that we need to be particularly worried about.
That's interesting. The political risk, you're not too worried about?
I'm not particularly worried about that. I think the markets, again, have enough time to digest this. There is complete uncertainty around this. We know that for sure because this hasn't happened in the past. But at this point, do I expect large and sustained sell-offs across asset classes? I don't think so.
Roop, we saw quite a steep sell-off in emerging market
Yes.
assets November the 8th,
Right.
and it was particularly noticeable with Africa.
Yes.
And since, when I look back at the first quarter numbers, you've seen the peso top performing currency. Emerging market assets seem to me to have become flavor of the month again.
Right.
Can you just tell us a little bit about what you're thinking on that? And is this sustainable? I saw things like, if you look at the India rupee, the
Yeah.
Indian stock market is done well. Brazil, the South Korean won, untroubled by all these problems
Right.
in the peninsula. What's happening in your view?
I should tell you, Ali Khan, that I'm not a currency expert by a long shot, but a sort of a layperson's opinion on that question is, I think what you're seeing is just a normalization. So you had the specter of very rapid and aggressive increases in interest rates, ultimately leading to devaluation of emerging market currencies. So the big worry in a nutshell was that huge amounts of fund flows would take place from out of emerging and frontier markets into the US and more developed markets, and therefore more developed and liquid currencies, whether it be the dollar, the euro, or to some extent even the yen. And some of that has been found to be unfounded. I mean, interest rates have not gone up as much as people anticipated. For example, the US Treasury yield curve has flattened, if anything, after November 8th, the election results. The 10-year US Treasury is substantially below the 260 mark that it had hit at that point. At the end of the day, the markets have rationalized what they feared would happen. And what you're seeing now is a more normalization rather than a strengthening per se of each of these currencies. In other words, what you're seeing is dollar weakness rather than individual strengthenings across the board of all these currencies.
Interesting. If I come to Africa,
Yes.
We've had a ton of things happening lately. Obviously, recent events in South Africa with the termination of Pravin Gordhan. Let's just start. Let's just start at a high level. I mean, what are you seeing in the sovereign bond market, for example? Do you consider that efficiently priced right now, African sovereign paper? How are you? Can we start there? What are you seeing? And also, I overheard you speaking about the Ghanaian market. I saw they issued a 15-year bond recently. How would you characterize what's happening?
So just to address particularly the African Eurobond market, why that is important is, at the end of the day, Eurobond market has the sentiment that is most immediately material to us, particularly in the short run, because that tells you what the sentiment is of the international investing community. So looking at just the African Eurobond market, most of the bonds that we see now have come off from their lows. Ghana's Eurobond placement is a case in point. It had an interesting amortizing structure. I think they're trading across the board. All the larger, more material economies within Africa who have Eurobonds, those bonds are trading at what I think are very fair levels given the risk. But the point is, now you're no longer seeing the selling pressure that we saw in the bond market, where the selling pressure to a large extent was just cutting of risk positions, which unfortunately it builds on itself when institutional investors across the world are just cutting risk positions, not completely sure about how this was going to pan out, but you are seeing massive avalanche, if you will, of risk aversion. That sentiment has gone. This is good for these countries, Kenya included, Ghana included, Nigeria included, because it does bring back investment into these countries at a time when dollars are still in short supply, particularly in West Africa, where the dollar shortage is much more pronounced than it is, let's say, in Eastern Africa. As fundamentally a bond guy, to me, what I'm starting to see is more interest in the take-up of those risk positions in Ghana, in West Africa, and again, even in the Kenyan bonds. So to your question, are these fairly priced? I think they are fairly priced. We have to keep in mind that there is a fundamental change in the liquidity situation in the market today. What that means is banks have lower risk appetite because they have less amount of capital to take proprietary positions in many frontier markets, and in fact in many bonds. That means today Eurobond markets are substantially less liquid than they were some years ago, particularly after the great financial crisis, and Basel III and Volcker rules have gone into play. Given that, given banks have more muted appetite to invest in these bonds for their own books, for their own balance sheets, I'm just gratified to see that these bonds are trading at more normal levels. And I think provided we don't have any external shocks, these yields are likely to continue compressing. So the spreads will continue compressing.
So you're advising sovereign issuers in Africa to issue now at these sorts of levels?
I definitely would.
Yes.
That means, yeah. So because the more you issue, the more confidence you bring in. I think the markets have digested the fear of interest rate hikes sufficiently enough. The markets are sanguine enough that there will be appetite for these bonds, as we've seen in the recent past.
No, I mean, I saw some interesting data saying that, for example, Nigerian Eurobonds, dollar-denominated Eurobonds, had outperformed African Eurobonds by nearly 100%.
Yes.
And that contrast with the domestic market was quite an interesting one.
Yes, because at the end of the day, the supply in the African bond complex, if you will, is still somewhat limited. So these are not economies that the investing community can disregard or ignore. Do they go through hiccups? Yes, they do. That's primarily because these are economies that are not very well diversified. They're heavily reliant on the commodity market. Import coverage is still relatively low in most countries. The absolute volume or the absolute levels of foreign exchange reserves are somewhat low. So yes, every time there is a hiccup, you'll see massive sell downs, particularly given the earlier point that liquidity in the market is still quite limited compared to what we saw, let's say, 5-10 years ago. But the bottom line is markets have shown a tendency to correct. I think there are fund flows that have a genuine interest coming back to Africa, and we've seen that in the resurgence in pricing and performance, particularly in Nigeria.
Let me come to Kenya in particular. You're visiting here, of course, and we've had quite a lot of fluidity in the banking sector. What do you think of this interest rate bill that seems to have, how do you sitting in your seat, what's your response? Was it the right thing to do?
The cap.
Yes.
It was inevitable.
Yeah.
Kenya is not the first country to do that. It is a way of intervening in the markets to cap rates, to lower or pressure yields to go down. It was absolutely inevitable. It's not for me to say whether it's the right thing or not. Ultimately, though, I think the impact is without a doubt positive. It leads to development of the financial markets. Specifically, it leads to the development or better development of the capital markets. I think it whets the appetite of investors. We do need, particularly retail or non-institutional participation in the capital markets. This will whet that. For me, looking at it through a very narrow fixed income or bond lens, this has been good for the bond market as a whole, because the demand in yield-driven products such as bonds has gone up. So if I take, as you've asked for, a very macro view from an outsider's point of view, from the point of view of a student of the financial markets, I think in the medium and long term, it is the right thing to do.
There's been a criticism, first of all, saying that it's slowed down private sector credit growth because the banks are not comfortable with maybe lending money at the cap rate to certain customers. And another criticism of it has been that it's blunting the ability of the central bank to respond on a monetary basis, monetary policy basis. Any validity to those two claims?
Yes, there is, I'm sure. So the first point is, I think, a very, very important question that you raise. The lack of appetite to lend, so therefore the fall off or the plateauing out of credit growth. That's not necessarily a bad thing. I mean, what it is leading to is a reevaluation of the risk. At the end of the day, Will banks ultimately end up lending? Yes, that's their core function. But maybe the risk needs to be repriced. And something like this, which leads to a reevaluation of credit spreads, or in other words, the cost of credit, will only lead to a consolidation, will lead to better decision making, better risk management, and ultimately better credit quality in bank balance sheets. So that's not necessarily a bad thing. And to me, that's, of course, mine is a very long view, it is a very macro view, and to some extent it's a generic view. But I feel strongly that the lack or slowdown in credit growth is very much likely to be a temporary or short-term phenomenon.
Let me ask you to describe to us, somebody like yourself, what kind of product, product are you showing to your customers as Standard Chartered? How does somebody like myself, who maybe has a view on something, particularly on Ghana, I'm quite bullish about the currency, I like the idea of these long-term bonds. What are you able to transact in these markets? Can you tell us a little bit about what you can do?
That's a very relevant question. Thanks, Haligan. So it's a very relevant question because it is close to my heart. I have absolutely no doubt in my mind. So the main purpose of my coming to Africa and visiting specific countries, the countries where we are and have built a fixed income or bond business, the main thing is to try and highlight the positioning of this asset class, fixed income, in customers' portfolio. So to back up and answer your core question, what it is that we offer. What we offer in each individual market, such as Kenya, is what we think is a complete suite of fixed income products comprising government bonds and corporate bonds, local bonds and non-local bonds. And the message that we want to leave behind is, A, the suite of products that are offered is complete, and B, we want investors to be very comfortable with the notion that fixed income or bonds form a core part of their portfolio. And as a corollary to my second point, I also have a sort of personal agenda. I make no bones, as I mentioned in the presentation just prior to this conversation with yourself, that I have a biased view about this asset class. It is the only asset class I've worked in all my adult life. I'd love to be able to make it more democratic so that more investors have access to it, more investors feel a familiarity with it, and above all, more investors understand the intrinsic value of this in their asset class. So we offer a full suite of products. We think the products that are offered are the appropriate products for their clients, and the products have both a certain depth and a certain width or breadth to the offering. So can you, sitting here, invest in Ghana? Depending on your profile, the answer could be yes or no, because it all depends on what your risk rating or what your risk profile is. If you have the appropriate risk profile, the answer is yes, you could.
Excellent. Can I just ask you to give me a final answer? Africa Rising was the theme.
Yes.
And if I look at GDP growth rates, we're at 20-year lows, South Africa and Nigeria weighing on that average. Is it rising? Is it, where would you put Africa right now if you had to give it a name?
Is it rising? It is definitely rising. The variables in that question, I think your question is a very, very appropriate question. It unfortunately is a question that one could debate and talk about for the next hour, which we don't have. Is it rising? Yes. The big question is, what is the rate of growth, or what is the rate at which it is rising? So when we said Africa is rising, we romanticize it and imply that it's going to rise in a straight line without hiccups. That does not happen in a frontier market. As we discussed earlier in this conversation, many of the economies in Africa are not well diversified enough. Many of the economies in Africa do not have institutions that promote more steady growth or facilitate more steady growth through hiccups in the market. But ultimately, can we do without Africa? The answer is absolutely not. Will it ultimately come of age? Yes. Will we need to have patience? Yes. Will it come of age in a straight line? No. But I suspect, and in fact I know, you know these answers.
No, but thank you. Thank you.
You're welcome.
I couldn't agree with you more.
Yeah. Thank you very much for your time.
Pleasure.